welcome to the third video. It's going to be about a recap of what you can see on the screen. The three trades that were made on Wednesday, that is last week. And I just want to show you that actually the ICT works. I have made it my strategy. And every day that we keep on back testing, and at the same time, practicing with past data and the live data, it always forms the same things. So I'm just going to show you and give a narrative of what happened last week Wednesday. I had forgotten to actually upload this video. I was going to. So last week Wednesday, as we always said and agreed for the last two videos I've already posted, that always mark up the most crucial times, that is pre-market session. By pre-market session we mean anything before 9:30. Anything before 9:30. So let us give a narrative of what happened on Wednesday, that's last week, and how we would have found a trade here and there, given that you had the logic. Let us start. So on Wednesday at 7 a.m., where we always mark up our second line, always remember this is our second line. The first one is at midnight to mark up the start of the day. So at 7 a.m. the market rallies all the way up, creating this high with this week. But if we were to look just past this high that has been created after 7, there was a previous high that had been formed earlier. So the liquidity that rested right above the previous high was the one that was taken. And once the market did that, it gave us our first thing, which is our buy side liquidity, which is indicated by BSL. That being our high between 7 and 8, we wait now for our low to be formed. And we can see clearly that the low was actually formed before 8, which is right here. That becomes our sell side liquidity, denoted by SSL. So our strategy is based on the first liquidity to be taken out, then we take the other one. That is how I introduced this strategy. But there are some conditions when the market is actually trending, it tends to now respect the premium levels and discount levels. Premium levels and discount levels always occur between 50% and 61% retracement, and actually 78.6%. If you round up, that is just 79%. So what do I mean? Among the first two videos I've talked of, once the first liquidity has been taken, now let us try to see whether we can catch a move to take out the remaining liquidity that had been formed, that is between 7 and 8. And since we have our high that was created after 7 and our low before 8, the first liquidity to be taken was our sell side liquidity, which was actually a long dip which took out previous lows. Let me just show you these ones. They were taken out by this move that you're seeing here, and it created these lows, creating minor sell side liquidity, and actually retraced to a premium. The premium is what I've just said, between 50% and 61. I didn't give the mark for 79%, but now you get. Now the question is, how would you have taken this trade knowing that we are not going to take this fast? First thing first, you check how is the market reacting at premium levels. Why am I saying premium? Because the market was actually selling off. Since it was selling off, it means retracement were actually coming to a premium level. So you're supposed to check how are they reacting at the premium level. And our premium level, if you check keenly, it had something else. There was this up close candle right there, which I've actually highlighted with this rectangle that you're seeing, the gray rectangle. After the market went higher and retraced to that place, which was actually above 50%, giving us a deep premium, it respected it and just poked it a little bit at the middle with a wick. Let me just show you. It gave us a small wick, but the bodies respected it. So that would have been a great place to enter as you target this sell-side liquidity that was created right here, which you see that would have been your first partial before targeting something lower than that. Why am I saying that? Because if you check keenly, the market made this high and this low, retraced a little bit, dropped, gave us this low, then retraced to a premium level and went lower past this liquidity. But how far it would have gone, it was based on whether you know how to measure. And if you can see clearly, the measurement that I took, somebody would have been satisfied by this low being taken first, and that would have been a very great trade. But for some, they would have still caught this if they knew how to measure. And thanks to this video, some of you are going to also know how to measure. So what we do is we take our Fibonacci retracement tool. For the few that don't have this type of fib, you can take the default one and try to reset the data to what you can see here. Then you place it on the first high that was created at 7, right there, to the low that was created before 8. And you can see clearly that it gave us a target. When the market was selling off, it gave us a target of negative 2% standard deviation. Then further it went and gave negative 2.5 later on. But we always take the low hanging fruit, which is negative 2 standard deviation. That was our first trade. Let me just take this thing out so that we can see clearly. So I hope you get the logic of why we didn't go to look for buys at this premium level to take out this buy side liquidity. Instead, we checked at the reaction of what the market wants to do at this premium level. And what we can see clearly is that the market respected the premium level and it went for lower prices, which gave us a standard deviation of negative 2 as our target, and that's the end of it. After that, the market went lower. Actually, it gave us negative 2.5, but always strive to take your profits at negative 2 standard deviation. And if there's more volatility and you see it clearly, then you can always take at negative 2.5. After that, the market opens between 9:30 and 10:30, where we had a very big retracement from the first move from 7 a.m. to around 10. Yeah, around 10. The market retraced to a specific level, which you can see clearly it's the yellow rectangle delineating this order block. The orders that were placed here for this rally actually, and the ones that actually gave this price a retracement right here, now is being respected right here. after the market opens. I want you to see it clearly, so I'm just going to zoom in as much as the rest of the data is not going to be seen. I hope our point of focus is now here. Now, since this is the order block being respected right here, we want to see any signature to see whether we can get a sell or a buy. But now in this scenario, the reason why we took a sell instead of a buy is because it gave us a change of character. What does that mean? Or a change of, a market shift. A market shift is this. As you can see, there was a fair value gap that was actually formed right here before the market went all this way to this order block, which the bodies respected as much as the wicks actually did the tested the closement and encroachment. After that, we can see a drop and a close of candlesticks right below the fair value or the inverse fair value now, because it has changed its function, and we can see that it is being tested right below, giving us an entry right there, and the market rushes all the way to the low that was created at market open, and the market went all the way further to previous lows. If we are to check, these are previous lows that were created the previous day. If this was on 7th May, then 6th May, there was some lows that were created in the PM session, and you can see clearly that the market came for them. Let me just, exactly right there. These were those lows. This green line, it indicates those lows. The market gave us a clear place to actually take out our profits, and that was the second trade. After that, in the PM session, now that is in the afternoon, after this consolidation, the market retraced further, and you can see clearly that there is a pink rectangle in the middle, or that comes from this BC formed during the market open. And at that time, the reason why I won't talk much about this trade as much as it was something that somebody would have actually benefited from, is because it is happening between 12, where I actually stopped trading, and I hope to get trades at after the lunch hour time. Then I come back to around 2 to look for setups now in the PM session. But since now we're just looking for trades at the market open and before market open, then I believe the first two trades are the most convenient for now. But since we're already in it, let us try and explain why we took it. If you look keenly, the market retraced in the afternoon session to this BC, respected it with the body as much as the wicks did the damage, that is just poking out. The body is respected, and actually it sold off. It sold, hey, my English. It sold off from here to right here. Then it retraced back into the same BC to the near the closement encroachment, as much as it didn't test the closement encroachment of that BC. We can see clearly that there was weakness, that the market wants to drop lower. Now, this is what gave the confirmation for this trade. If I was to zoom in further, you can see clearly that once the body respected the BC created in the market open, there was this voluminous candle that actually closed below, it closed below this fair value right here, because this low was taken out by this voluminous candle. Then we have this third candle, which would have been actually a perfect entry, and you can see we would have taken a sell right there, but instead what did we do? We waited for this retracement. Since the market came back to that same place, we took a sell, and our stop loss was right above the high that was created by this wick. And you can see clearly that after that, the market gravitated lower to the lows that were created before 12, and went lower to a fib extension of 161.8%. I'm just going to show you clearly where this extension comes from, and why we would have gotten right out there. So let us see how that Fibonacci tool worked right there. So if we take our fib, let me just place it in a way that once I measure, you're going to see clearly that it falls at this Fibonacci extension, because we need to understand why the market at these key areas, at the swing points, the market always has a way to tell you get out, and those levels are the most important. I've shown you how with the measuring using the standard deviation tool, that fib that I had introduced. Now, for us to know how far this sell-off was going to go, we can see clearly that the market came all the way to 1.618 fib. But how would we have known this? Let me give you now the gist of the matter. We take our Fibonacci extension tool. You just apply the default one. You take the high that was created at 7 and the lowest low that was created before the first retracement happened. The highest retracement we had was after market open. So the low at market open, and actually we're going to take it to that place where we had our order block right here, and we can see clearly that this was a sell-off, this was a retracement, and after that the market went lower to a point or a level in the fib extension that is 1.618. Right there is where our third take profit would have been in the third trade. That would have actually a perfect trade because the volume was so high at that time. Now that you have seen, there's something that I overlooked, and I've already shown it here, which gave us more confluence of why the market was to fall. So suppose you missed this trade right here, and you caught the market when it was retracing, let's say before 2. The market before 2 had a fair value right here because there were equal lows here that were taken out by this voluminous down close candle, left a fair value. The fair value was retested with a wick, but the bodies respected it because they never came closer to it, meaning there is more anticipation that this market is going to fall. It shows weakness when these bodies don't actually close above the closement encroachment of the fair value, and the market went lower. I think apart from that, there's also another line that you can see in this place, where I'd indicated that there was no gap on, that is 16:59 p.m. We always know that in this index market, we check whether there's a gap before the next day trades are taken. And if you go back to, now since this is 7th, if you go back to 6th in NASDAQ, you will find that there was no gap. So that's why we always have to outline the time when the gap occurs. It occurs at 6:59. That is when we have the last candlestick being printed. Then we stop for like an hour. Yeah, an hour. Then the market reopens at 1800. And since there was no gap, the reason I actually delineated that line is because it affects our future trades. So once you see that this place and where the confluences are happening is where we also have those gaps. Unfortunately, there was no gap. So as you can see, as much as we didn't have a gap, it was a place where market had many swings. Check, for instance, we can see right here,